Hey, it's George from Triangulated back with another weekly episode of Listen to the Markets. This one's going to be a little bit different than the norm. I'm going to inject some opinions here based on some of the stuff I'm seeing, but we'll start with sort of the usual routine. So the main thing that I'm seeing, if you couldn't already figure it out from the image of for this week's audio clip here is the bond market is sick. It is not doing well. It keeps falling and it really can't get out of its own way. And I looked at the longer term bond ETF, which is TLT, and it's down over 50% since the year 2020 in price terms. And the 7 to 10 year bond ETF, IEF, is down about 25% in the same time frame. So this is what a real long term bear market looks like. It's just ugly, and you got to feel bad for people that bought and owned bonds thinking that they were a safe place to put money. So what's causing this drop? I guess the latest wave of decline in bond prices. And from what I'm reading, supposedly Fed Chairman Kevin Warsh, he just assumed the job recently, is likely going to raise interest rates to combat inflation, and so that's causing rates to rise. That's part of the explanation that I'm hearing. But I'm also hearing that given the sort of ever increasing amount of U.S. debt and the fact that Trump changes his mind so routinely on so many things, that people just don't really view U.S. bonds as favorably as they used to. So as to which of those is entirely true, I think I use my maxim: the truth is probably somewhere in the middle. But what is true and what is clear is that the bond market continues to look pretty terrible. So the other thing is it's the bond market experienced basically a 40-year bull market from the early 1980s, late 1970s, early 1980s until the early 2020s. And I think that we're on the other side of that at this point. As to how long the bear market will last, hard to say. But yeah, I think that 40-year bull market that propelled a lot of things is over. And so why does that matter? Well, in my opinion, interest rates, at least at the extremes, really dictate where money goes. And so if you think about it, most people that are listening to this probably have been through the zero interest rate policy environment. And what you see is if you can't get any yield on bonds, once the dust settles, if there's a crisis or something, you try to find somewhere to put your money that's going to earn some kind of yield. So really low interest rates incentivize people to go out and invest in stocks or projects or basically spend money, which is essentially positive for growth. The flip side of that is if interest rates get high enough, why would you go out and take a risky investment when you could buy the quote unquote, in theory, risk-free bonds? So back in the 80s, I think the yield on maybe it was tens or longer bonds, but it got near 20%. And, if you look at the long-term returns on the stock market, the average return is maybe 10% on the S&P 500, depending on what time frame you look at. So if you could get above that in a risk-free government debt instrument, why wouldn't you, right? So ultimately, interest rates, the point here is that interest rates dictate where money goes. Now, I am starting to wonder if we'll call it quote unquote calculus on bonds being risk-free is changing. And I wonder if the debt levels and the things that are happening in the government are sort of leading the bond market to tell us something. I do a lot of reading of transcripts from earnings releases from my Secular Trends publication. And essentially, the private equity firm Apollo recently said, and I quote, "Consumers and businesses are actually in great shape. Governments, not so much." So, yeah, the bond market is sick. I think it's telling us that things are not all A-OK. There was a book written by Reinhardt and Rogoff about 15 years ago, and it was called This Time is Different. And essentially, it pointed out that once countries get over a certain percentage of debt to GDP, things don't tend to go well. They're kind of past the event horizon, and they have to inflate their way out or something else, default on bonds. Whatever happens, nothing good happens. Now, they walk that back a bit after they got a lot of slack for saying that. But I think we're either at or past those levels at this point in the United States. At the same time, I've talked to some financial advisors. I mean, my sample size isn't hundreds, but I talked to enough that I think I get a good sense. And what I see is they are largely abandoning their modern portfolio theory driven models in favor of increasing stock allocations because if they own bonds, they're going to get fired. And, I think it points out that when the going gets rough, process takes a backseat to survival. Advisors want to listen to what their clients want. They want to keep their clients as their clients so they can keep earning fees. So add all that up, and it just doesn't smell really good. At the same time, Paul Tudor Jones, the famous macro trader, was interviewed on the Invest Like the Best podcast recently, and he pointed out in a couple different ways that the United States is increasingly reliant on the stock market, which I think all else equal is not the ideal way to be. That said, stocks continue to march higher. And I think you look at the long-term yields on bonds at this point, they're a little north of 5% when I looked earlier today, which compared to the stock market doing 20% or so a year is pretty lackluster. I think expectations on stocks, in my opinion, have become pretty much out of whack with long-term realities. Maybe we've entered a new normal. Hopefully we have, but I have to wonder. But you see people that they're just moving away from bonds more into stocks. And maybe I'm spending too much time online reading doomsday material and my view is getting clouded. But when I look at the bond market, it tells me that something is not right. Something is wrong. And interest rates, again, are, I think, at the core of everything. So, I guess what I will say is that I don't invest or trade based on my feelings about things because I've found my feelings are pretty, they're not as good as following good processes in terms of how to make money based on how markets actually move. I also know that doomsday narratives can be easy to buy into. And I know that markets can remain irrational longer than anyone can remain solvent. So I definitely, on a personal level and as a money manager, intend to continue to follow the process that I followed to make money. But on a personal level, I'm just finding it very hard not to be a little concerned with what I'm seeing. Beyond what I've talked about, I just see signs of excess everywhere. You've just got, I wrote about it a bit in the report for this week. I won't go on too long here, but there's just lots of signs of excess that make me think that maybe we're nearing I think if we were in an era, this is not the slow, steady, stable phase of a bull market. This is more like the blow off top. That's not to say that the market's going to come down or crash or anything. But I think when you look at the bond market, you look at other things happening, you look at the signs of excess, it certainly gives me cause for caution. And it makes me glad that I am using trader principles, since these principles protect against an uncertain future. And that's what I do with all the investments that I have or do for other people. And on that note, I actually turned my trader principles research into an ebook. So I'll end with a plug for the ebook. I'll provide a link to it, but you could go out and read that too, and it could give you an idea of how to play defense potentially if things don't work out too well. So I do hope things wind up being okay, but when I look at the bond market, I look at everything else, it's really hard not to be like, oh, this smells a lot like periods historically right before things got, or reasonably close to when things got pretty ugly. So here's hoping I'm wrong, but that's this week's Listen to the Markets, and I'll be back next week. Thanks for listening.